know that it was a show and tell event today. We'll have proof that I was actually there in a giant chicken costume. All right. Good morning, Randy, Jackie, everybody else. Good to see you. We are going to dive into this as we always do. Give me 1 second. We're having all kinds of technical issues this morning. Cats chasing dogs, things along those lines. All right. There we go. There's our guy just pumping a capital into the financial system. Look at that. That's good to see. All right, we'll do the moment. We'll talk about momentum in a moment. We'll do the runner at 9 o'clock, as we always do, and explain. No, it's not really QE, is it? Is it? We'll talk about that in a moment. As always, you're joining us this morning because 9:30 comes quick. We have a fascinating week lining up. Money rotating into different sectors, different stocks, different equities. Some deals being done this morning. And at 9:30, a lot of that positioning from Friday will unwind, and we will see markets move in a myriad of directions, different equities, different sectors, all on the move. And we're going to talk exactly where smart money's positioning right now. We'll go through our top screens and top strategies for the day, talk about some of the names that we're looking for on the reversion side this week, and of course, whether or not this is a good day or a bad day to trade. It's always a good day to trade. And as always, with momentum, well, this is an interesting little one because we have had some developments in the last couple of days that typically would be quite bearish. But I'll tell you, there's this little thing going on right now. It's called the AI trade. You guys ever heard of it? Raise your hand if you've heard of the AI trade. If you this new thing, got this new thing on the internets. It's revolutionary apparently. It's the AIs. That's what the kids are calling it. And the key thing here is this AI inflow, all this capital that continues to flow into the sector is really holding up this market, and in doing so in a way that kind of defies a little bit of mathematics. Now, we measure the number of stocks breaking out versus breaking down. We're not necessarily looking on the aggregate of dollars in and dollars out unless we get into an environment like right now. And this is kind of where it's not a danger zone. It's just a reminder that these markets operate on flows. And one of the key things that has happened in the last couple of days, well, I'm trying to pull this one specific chart up. I can't seem to find it because that's just how things go. There it is. I found it. 1 second. Here we go. Let's pull this one up. This chart that I'm about to show you shows what happened on Wednesday of last week. This is Wednesday of last week. This is the S&P 500 daily breadth versus the daily change on the S&P 500. Well, what the heck does that mean? Well, here's this. The S&P 500 was up on Wednesday. Okay, we get that. The number of stocks that were down compared to the number of stocks that were up was minus 294. Minus 294, yet the stock market was still up. That crowding moving heavily into, again, that AI trade, those magnificent seven stocks. That is the worst breadth for an up day since 1990, since they actually started tracking this, despite the fact that, again, the explosion of all of the passive funds, etc., money continuing to flow in. Here's the month of October. Now, this is a little bit of a blurry chart, but I'll show you what you're looking at. You're looking at the red line, which shows, well, a nice move up on the S&P 500 for the month, but the net of advancers to decliners minus 84 for the month. So concentration remains extreme in this environment, and that is how you can continue to see the S&P 500 burning higher, pushing above that 8-day moving average, that 20-day moving average, that 50-day moving average, and taking us back to all-time highs. Remember, heavy concentrations in these names: NVIDIA, Apple, Amazon, Microsoft, Broadcom. Okay. Why does that matter? Because when things break, really break, it comes with evidence of the FNGD, right? This is the FANG inverse ETN. Don't worry about what it does. Just know that it is linked to FANG Magnificent Seven's debt and concerns around leverage that of those stocks. The people who are buying up the stock, taking it to the repo market, rehypothecating that stock, taking a little bit of a haircut, then going and buying more stock and leveraging up, taking $100 million and building a $400, $500, $600 million position in the exact same equities that everybody else is. And then when there is a problem in the plumbing of the financial system, this unwinds very quickly. We saw that happen in March. When this breaks out above its 50-day moving average, something is off. I started here on March 1st, first broadcast, and I said something is off. Well, because the week prior, this breakout had occurred. Now, all of this matters because, again, the market can continue to bleed higher. The S&P 500 can continue to bleed higher if the money keeps going into the Mag 7 because, again, huge amount of weight, huge amount of volume, huge amount of flows. Once again, you see the mags here, seeing the way that this has just burned higher since that April downturn. Now, all of that said, you see the number of stocks that are breaking down in the S&P 500 is substantially higher than the S&P 500, yet the S&P 500 momentum remains solid. Okay, intraday down, overall weekly up. Russell 2000, however, under stress, has been under stress for 2 weeks, continuing to show weakness. Small cap, a lot of focus on those companies that are zombie stocks, the companies that need to refinance debt, and the concerns around the fact that the Fed is now signaling that there may not be another rate cut in December. That is why this week is so important. We are in the middle of a government shutdown. We will not get on Friday the unemployment numbers. We have to rely on private sector numbers this week. That is going to be critical. This week, the Fed, right, has signaled less certainty around rate cuts. We go over to the CME Fed Watch, CME Fed Group, CME Fed Watch, CME Group. Wow, still off from last week. And the odds of a rate cut, another rate cut in December, right? We just had one last week. We went down to a Fed target rate between 375 and 400 basis points. The odds have fallen from roughly 91% right here last week, 94%, forgive me, down to 67%. So right now, that is why there is stress on a lot of these names, these companies that really were anticipating another rate cut, and a lot of investors who had been speculating on that rate cut, those bottom names, those consumer defensive names, they're under pressure. And yet, nobody cares about the S&P 500 and the Mag 7 stocks because guess what? They're not dealing with debt. In fact, they have so much cash on hand, they're actually benefiting from higher interest rates. Amazon, for example, does not pay its suppliers for a minimum of 45 days, which means they have a interest-free loan from their suppliers that they could just park in the markets, just collect short-term cash. Pretty good little situation they got going there. But for everybody else in the real world, higher interest rates will impact discounted cash flows, will impact for performance. Now, on top of this, the U.S. dollar is at a 3-month high. And Blake has talked about this. Blake talked about this a couple of weeks ago. He said, look, dollar goes higher, markets face pressure. It doesn't mean that just the S&P 500 goes down. Because again, that dollar strength is not going to necessarily impact Amazon and Apple the same way that it's going to impact a company that has higher debt issuance and deeper concerns around rate policy. Companies that have the stronger dollar, that are international, that have more debt, that have deeper concerns around their financials. Why does this matter? Well, it matters because they're going to have to deal with quarterly impacts on currencies from abroad. The U.S., the foreign dollar, the foreign currencies buys less U.S. dollar. That impacts conversion, impacts Forex, impacts their bottom line. So despite policy easing, the U.S. dollar remains strong among this resilient economy. Again, very AI CapEx driven. Traders are watching private indicators this week. We have the ISM, manufacturing and services data, and we have the jobs report on Wednesday. This is the private sector jobs report. And it's important because, once again, if we go and look at all of the individual jobs that have been created over the last 2 years, heavy reliance on healthcare, which are basically government by proxy, social work. The question is, what's happening in our manufacturing? What's happening in our service sectors? What's actually happening in the private sector? And how will that impact the Fed's view as they move toward that December meeting? Finally, it really is about AI, right? A lot of hype around AI. I don't know if you've heard about this AI, but I've heard it's the future. I've heard it is just unbelievable, and I just cannot wait to go to the YouTubes and learn about the AIs. Asia Pacific markets are moving higher based on trade optimism. Stocks across Asia have risen, and I encourage you, as always, to be paying very close attention to what's going on in China. If you did not detect the sarcasm around the AI hype, welcome to the show. But WB, watching Weibo, look, these names have been beaten up. This is a great momentum stock. China has been easing. I have to be patient. I have to wait for that blue line. See that blue line on the right side of your screen down by 1088, hovering around 1120. I need that blue line at 1117 to move back above that orange line. I need to see some momentum return. I need to see the MACD down here start to turn and the histogram to turn positive. I need to see flow in the money flow index. I need to see RSI and price improve. If these stocks move to oversold, I will adjust my strategy. I will sell puts to the downside and look for reversals. If these stocks start to showcase momentum, I will follow them higher. But for right now, again, headlines, not a lot of information that's going to give me a ton yet. We will be discussing this a little bit more, and I am dedicated in following the RSI and the MFIs, looking for clues into whether or not this China rally and what's happening in Asia really is real. Okay. Top of that, again, ongoing enthusiasm around AI-related investments, offsetting that weak factory readings and concerns that we have about China. In addition, China's housing market not looking good year over year. But hey, when have we cared about the economy when we can just engage in nice levels of quantitative easing and call it something different? We'll talk about that in a moment, but we got to get to 9 o'clock, and there's only one thing that we do at 9 o'clock here. Charlie. He missed it. He missed his opportunity. Oh, he made it. There he is. Right on time, 9 o'clock. Thank you, Charlie. Welcome to the runner. All right, every day we do. I'm going to go back to these slides in a moment, but it's 9 o'clock. 9 o'clock means runner time. And we obviously are focusing. Run, Charlie. We are obviously looking for opportunities on this Monday. Now, I'm going to talk about the regional banks at 9:10, and I'm going to dig a little bit into what's going on here with the plumbing of the financial system. I've been short the regional banks, but there's one little rule that we know about the banks. Don't fight the Fed. Looking at the numbers and the stocks that are strong, this is a Gianni stock. He's probably already trading this right now. He's probably owns 50 lifts, probably has his own lift business, for all I know. Just driving around in the back seat, self-driving, trading stocks, flinging momentum. No big deal. Like to see the improvement there on the 50-day moving average strength coming out of the backside, 8-day, 20-day. Interesting name. Again, Uber's getting all of the attention. I can't lift. Well, you're seeing MACD improvement. We want to see that histogram turning. That MFI, little choppy, but positive on the ADX. We're looking for continuation of trend, continuation of momentum. And as I'm going to explain in a moment, well, funny enough, the event that happened on Friday may actually present a little bit of a short-term pop for the market. Funny how that works. But with lift, what I'm specifically looking at is going out to that November 21st period, staying long and using the leverage of the system itself. Using the leverage and, of course, keeping my eye on that 15-day. A 15-day is going to be very critical. Our 15-minute chart will be very critical today, looking for continuation of trend higher on this stock. Lyft is currently trading at 2060. I like just staying in the money. Very simple. And looking at something like the 19 call, because if I trade the 19 call, it gives me a very specific setup, right? I need this stock to get back to, in 2 weeks, 2148, right? 2148 for this to break even at expiration. If we move to 2140 today, the stock's up, this position's up 23%. If we pull back and break down to that 50-day EMA, my position's down 16%. That's my stop. I'm looking for this to move and rise with its 50-day EMA. I'm looking for a continuation of strength and for, again, that sideways to lead higher, to take a stair step up. So once again, 40% probability of profit, break even at 21.50 for November 21st, the $19 call, somewhere in that 250 range. So that would raise me up to about 11.50 on a break even. But I'm looking for a move at least back to 22 and a stop right back at that 50. If we break down, let it go, move on, get on with your day. UEC, what do you do? Well, you get 15 guesses and the first 50 don't count. That's got to be mathematical, right? Uranium's been an absolute monster recently. Big reversal that came back here on the 22nd of October. And strength, here's the thing. This has moved much higher in recent days. A lot of people start to chase when we get up in these levels. And I just state the long-term trend is here, right? The long-term trend is in uranium. And once again, the gold, the silver, and everything else that comes with it, all roads point to more debasement, more monetary inflation, higher commodity prices. So I don't have to chase this higher. I can sell spreads on something linked to uranium. I can do it with the URA. So the UEC gives me a little bit of focus, the Uranium Energy Company on the AMEX, forgive me. Oh, New York. Where is that? Is it down on Battery? Can't remember. 21st. A little bit of a wide spread, unfortunately, but we'll look at UR. I'm going to look at URA in a second. If I can get this to fill properly, I could sell for December 19th the 13 put and buy. Forgive me. Let's go even lower than that. Let's go. Let's get real wild with it. Right now, the 1210 on the UEC with a 65 on the 12, if filled, if you wrote a 65 and you were able to buy and fill on a 10 at 25, that would be $160 to make 25% return, 200% annualized, roughly. 1160 becomes your line in the sand. So this is a bullish credit spread. Selling the 12, buying the 10 in December, well below these key moving averages. Your UEC goes up higher. You make money. UEC trades into December above that key level. You'll make money. And again, something that you're going to want to own for the long term because, again, all roads point to monetary inflation. 78% gain or probability of profit. So Once again, long lift with an individual call at the in the money level in November 21st at the 19 level, and selling a spread. The what did I say? 1210 for December, 25% targeted return. All right, that gives you two trades to start your day. But let's just look at DMLP. This is not a tradable name. This is a energy EMP limited partnership that has been beaten up pretty badly, actually, too. Question is, what point will this finally hold? What point will this finally hold? 15% dividend, probably not sustainable. I will just simply state that, but this is a midstream name that has seen a lot of insider buying in the last year. So if you are the brave type, dive into DMLP. It is trying to wake back up. And once again, if you are able to secure that dividend, this is something to potentially buy ahead of that X date if you can. But just add it to your watch list. This thing has not recovered, obviously, since that big downturn that started at the beginning of the year, 34, but looking to finally wake up and get some support. Pay very close attention to the weekly. Again, this is 8 weeks against 20 weeks. We would like to see some reversal here, some strength. Add it to your list. Starbucks, Peloton, and MTH are under pressure. Starbucks, not really the best news, right? It's not really about people going in and living in their bathrooms anymore. It's really about the fact that nobody really wants it. Continuing to break lower. This is a tough one, but nonetheless, again, you see these lows where this stock has been. And if you are looking to continue the trend to the downside, I don't blame you. RSI, MFI, MACD, and ADX all ugly. It has broken under its 20-day. It's really under its 50. That is the key thing to pay attention to. But look at the 8 and the 50 adjusted. The EMA. So I have the SMA up today. It's fine. Doesn't matter. It's not gonna completely alter your world. But I should be moving this here. One moment. It's not gonna change everything that drastically. But are you kidding me? Look at that. It did change everything drastically. It made everything melt together. Fantastic. Try again. There we go. Much cleaner. But once again, the real move was, come on. Sorry. Real move is that 8 falling back under that 50. Starbucks, not good. Peloton, still in business somehow. It's always worth a short once it breaks under these 3 key moving averages, but a 30-cent move, I'm going to hold off on this one. But, I mean, just keep the pressure on when you start to see these moves. 8 under the 20. This thing can move very quickly to the downside, and you just stay in the money. Trading the 8, trading the 750. You don't have to go out of the money where the low probability trade is. You can make money just by staying at key specific levels. If you sold the 8, forgive me, if you bought the 8 and sold a 750, if that's an availability, that's not a bad trade either out a week and a half. But Peloton, you know what to do. This is a short squeeze stock. So as always, looking for movements above these key moving averages and paying attention to things like ghost prints, looking for opportunities if those squeezes emerge. Finally, MTH, I know you. Affordable housing. It was like a month ago that we were all like, oh, we're going to have affordable housing again. And then that just disappeared. It's amazing how quickly these stories dissipate, is it not? Well, that's why you got to focus on the day-to-day. And then if there really is a long-term trend, you will see it in the monthlies and you will see it in the weekly charts. Nobody really cares about affordable housing this week. We'll talk about it, I'm sure, in December again when interest rates are back under pressure. SkyWest is one of my favorite stocks of all time. Bought it at 17 once, sold it at 120. Continuation of trend here. There is some obvious obvious weakness in the overall market for the airline companies. But again, this is really just about trading, right? So trying to swing this, pretty simple. Key moving average here, tight stop, looking for a move back to 110. If we can get back above, we tested it at 103, 104 level. You could take some profit at 105, play for 110, set a stop at 98, 88. And Tidewater, we got some M&A going on right now. We got a lot of focus again in the upstream oil and gas space. Tidewater looking to rebound. Play for that 50-day moving average, that blue line, right? Here we are at 52.24. Stop back at 48.51. Looking to try to get back to that $55 level. Looking for a movement and continuation of trend on the 8 and the 20. There's your runner. Let's go back through and just make sure that everyone got that. Edwin, good to see you. Hope you're doing well. You guys are just on a roll this morning. Johnny Fingers. Is Garrett not on today? Oglethorpe, come on. Did I lose weight? Did something happen? Hit refresh. He doesn't know. Oglethorpe or she or who knows? Could be anything. All right. Hit refresh. All right. Oglethorpe didn't. Okay. All right. Headlines real quick. Let's dig through this real quick. So I want to explain what happened on Friday. The Federal Reserve, I don't know if you know who they are. They are a band, an alternative band that really took the world by storm in 1913. Has had a couple of hits along the way. 1993, their hit inflation targeting. 1971, Goodbye Gold Standard. 1945, Bretton Woods. 2008. Oh no, that was 2007. Sorry, that was Ben Bernanke as the lead singer. That was Subprime Crisis is Contained. Really good hit. Quantitative Easing was a great album. QE1, QE2, QE3, QE4, and now QE Infinity. Great albums. Make sure you check them out. The Fed injected, welcome to the show. The Fed injected $29.4 billion via overnight repos, and I was right. Hey now. So once again, the central bank just engaged in the largest repo operations in 5 years. Okay, what does all of this mean? Okay, real simple. Fed quietly pumped money, capital, into the system through what are known as repo operations. Banks and dealers bring treasuries to the Federal Reserve overnight, and they say, hey, we need cash. We got to fund our operations. We need money. So the Fed gives them cash in exchange just for a day or two and then takes the money back a day or two later. It's basically a short-term loan. It is not long-term stimulus. I get that. Because short-term funding is tight. Remember, the banks are lending to one another. Reserves in the banking system, though, have dropped to $2.8 trillion, which sounds like a lot of money, but it's actually low for today's structure. 2.8 is high compared to where we were in 2019, the last time we had a little bit of a spasm like this. It was like 1.7 trillion, but we drastically increased the reserves in the system after 2020. Okay, money will get stuck in the Treasury General account and the reverse repo facility, which starves private markets for money. And the repo action is like the Fed opening a pressure valve, letting a little bit of money back into the system so that things do not freeze up. They're not trying to spark a bull market. That's really not what they're trying to do. They're just trying to keep the pipes from freezing. So how is it different than QE? Well, QE is when the Fed actually buys assets. They'll buy mortgage-backed securities. They'll buy long-term bonds. They basically print money. They adjust their balance in their computer. They send that money out in the system. They buy assets. They reduce bond yields. They stabilize. They permanently expand their balance sheet. Repo operations are short-term loans, so they lend the money against the treasuries, and then that cash technically disappears when the loan matures. So QE is opening the faucets, and repo is like being in the bathroom and hitting that thing over and over and over again. It doesn't work. It's like, damn it. Like, does any of the water ever work in this gym sink? What's going on here? And then finally it does spray. And it will usually turn on when you're not paying attention, once you walk away. So the thing that matters about this is that it's actually a sign of stress. When repo volume spikes, something is tight in the plumbing. And in addition to this, the Fed banks tapped into the standing repo facility, which was, I believe, created in 2021 for $50 billion, which is the largest ever on record. Reserves dropped. Obviously, repo demand signals stress in the money markets. That can ripple fast. This can ripple into equities. This can ripple into bonds. This can ripple into global markets very, very quickly. So the Fed's not really stimulating the economy. It's keeping the things from cracking. But the reality is this. When you do this, it actually feeds the shadow monetary base. The Fed is not expanding the official money supply, but it's expanding usable liquidity, capital in the system. It's temporary, but this moves through balance sheets of dealers, hedge funds, money markets. It won't show up in M2, but it does expand the pool of capital. And that's what fuels leverage and credit and risk. And resultantly, when they do this and you get these events, well, suddenly markets can go up because, again, you're not seeing a lot of unwinding of positions in order to raise capital or flush to cash, because that's the asset everybody wants in periods of liquidity stress. So once again, just because this is happening, it doesn't mean that we are in a crisis type event, but it is a red flag. And it does showcase that once again, that the Federal Reserve in the last couple of months has come out and admitted how the system works. They have come out and they have admitted that their actions are really driving markets. And Lori Logan, down at the Federal Reserve in Dallas on Friday, said that if this continues, they may have to start buying assets. And if that happens, we are going to 7,500, 8,000, who knows how much higher, because QE and because of purchasing of assets puts more capital into the system, which is leveraged, which helps fuel risk appetite. Pay very close attention to the FNGD. Pay very close attention to the S&P 500's 20 and its 50-day moving average. Watch the 20 and the 50-day moving average on the Magnificent Seven, because that has been the driver of the market. Something is clearly wrong. These things are getting bigger and bigger. The cracks, the cockroaches are getting bigger. And everybody's seeing it, and people recognize this now. They know that this is, the Fed's talking about this. They recognize 2019. This is bullish for gold in the long term, by the way, because, again, all roads point to more monetary support, which points to more monetary inflation, which points to more demand for gold, particularly from other central banks that don't want something that is collateralized that suddenly has 15 different claims on it because of the way that the financial system works. All the while, I did not get to this chart. I will just point this out. Deal making is starting to pick back up. Buyouts. And where is this really starting to be a big focus? Consumer goods and healthcare. There's a reason for that. These are the stocks that have been beaten in very specific places because, once again, we have concerns about rate cuts. Look at the defensives right now, particularly consumer goods. You're seeing a lot of pressure under these names. That's the real economy. These are the things that are supposed to showcase that strong consumer. And now the deals, these companies are going to start to, again, merge out of necessity. We will be looking at Kimberly-Clark today for a possible way to trade it after the stock sold off the way that it did this morning. But do not speculate in consumer goods stocks simply because of M&A. Whatever you do, there's a smart way to trade this, but the reality is a lot of these names are falling knives, and there's still a lot of problems with a lot of them because of debt issues right now. So be very cautious, look for unusual options, pay attention to what Don is going to be talking about in the next 15 to 20 minutes, particularly around volatility and what he is seeing. Pay very close attention to Ghost Prince, pay attention to everything that we're talking about this week. This is a critical week for the rest of the year. I'm not going to say it's as important as last week because the Fed spoke, but obviously the key thing here is we are starting to see some shifts into the last 8 weeks of the year, and we are flying blind without data. It is going to lead to more volatility, and it's going to lead to a lot more question marks the deeper we go into this government shutdown. All right, Don's coming on momentarily. I hope that everybody has a great trading day. I will be back here later today at 3 o'clock. As always, I'm going to send it off to Don, and I'm going to guess that he is not playing the Monster Mash this morning. Take care, everybody.